Question 1. Benchmark analysis indicates that a long-term client, previously assessed as having a moderate risk tolerance, has recently expressed significant anxiety about market volatility and a desire to shift towards more conservative investments. However, during the conversation, they also mentioned a strong interest in a new, high-return but inherently volatile investment product that has been heavily marketed. As a banker at the State Bank of India, what is the most appropriate course of action to ensure client suitability and adherence to regulatory guidelines? Option A. Recommend the new high-return product to the client, emphasizing its potential for high returns, and assure them that their previous moderate risk tolerance is sufficient to handle the volatility. Option B. Immediately liquidate all existing moderate risk investments and move the entire portfolio into the safest available government bonds, disregarding the client's mention of the new high-return product. Option C. Proceed with the client's original investment plan, as their stated risk tolerance has not formally changed in the bank's records, and focus on upselling the new high-return product to capitalize on their expressed interest. Option D. Conduct a comprehensive review of the client's updated risk profile, considering their expressed anxiety and financial capacity, and recommend a diversified portfolio that balances their desire for safety with their stated interest in growth, explaining the risks and benefits of all options. Correct answer is D. Conduct a comprehensive review of the client's updated risk profile, considering their expressed anxiety and financial capacity, and recommend a diversified portfolio that balances their desire for safety with their stated interest in growth, explaining the risks and benefits of all options. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated risk tolerance and their actual investment behavior. A banker must navigate this discrepancy while adhering to regulatory requirements for client suitability and risk profiling. The challenge lies in ensuring that the recommended investment products align with the client's true capacity and willingness to bear risk, rather than solely their expressed preferences, which may be influenced by short-term market sentiment or a misunderstanding of investment principles. This requires a deep understanding of the client's financial situation, investment objectives, and psychological factors influencing their decisions. Correct approach analysis. The correct approach involves a thorough reassessment of the client's risk profile, considering both their stated preferences and their financial capacity and investment horizon. This aligns with the principles of Know Your Customer (KIC) and client suitability mandated by the Reserve Bank of India (RBI) guidelines. Specifically, the RBI's Master Direction Know Your Customer (KIC) Directions, 2016, and subsequent circulars emphasize the need for banks to understand their customers thoroughly to prevent financial crimes and ensure that products offered are suitable, recommending a diversified portfolio with a moderate risk allocation, backed by clear explanations of potential risks and returns, demonstrates a commitment to the client's best interests and regulatory compliance. This approach prioritizes the client's long-term financial well-being over immediate sales targets. Incorrect approaches analysis. Recommending high-risk, high-return products solely based on the client's verbal assertion of comfort with risk, without a deeper assessment, would be a regulatory and ethical failure. This ignores the potential for misjudgment by the client and could lead to significant financial losses, violating the principle of suitability. Such an action could be seen as a breach of the bank's fiduciary duty and potentially contravene RBI directives on responsible lending and investment advisory. Proceeding with the original investment plan without any further discussion or reevaluation, despite the client's expressed unease, is also problematic. This approach fails to acknowledge the client's evolving sentiment and could lead to a misaligned portfolio, potentially causing distress and financial harm. It demonstrates a lack of proactive client engagement and a failure to adapt to changing circumstances, which is contrary to best practices in customer relationship management and regulatory expectations for ongoing client monitoring. Focusing solely on the potential for higher commission from riskier products would be a clear ethical breach and a violation of regulatory guidelines. Banks are expected to act in the best interests of their clients, not their own profitability derived from unsuitable product sales. This would contravene the spirit and letter of RBI regulations aimed at protecting investors and ensuring fair business practices. Professional reasoning. Professionals should adopt a client-centric approach, prioritizing suitability and risk management. This involves a multifaceted assessment of the client, including their stated preferences, financial capacity, investment objectives, and understanding of investment risks. When discrepancies arise, a proactive and transparent dialogue with the client is essential. Professionals should be equipped to explain complex financial concepts clearly and guide clients towards decisions that align with their long-term financial goals and regulatory requirements. The decision-making process should involve 1. Active listening and probing to understand the client's concerns. 2. Reevaluating the client's risk profile based on all available information. 3. Presenting a range of suitable options with clear explanations of associated risks and potential returns. 4. Documenting the rationale for recommendations and client decisions. Question 2. Risk assessment procedures indicate that the State Bank of India needs to submit detailed customer transaction data to a regulatory authority for a specific compliance audit. The data contains sensitive personal and financial information. Which of the following approaches best balances the bank's obligation to comply with regulatory reporting requirements with its duty to protect customer privacy and data security? Option A. Anonymize or pseudonymize the customer transaction data to remove or obscure personally identifiable information before sharing it with the regulatory authority. Option B. Implement a complex, multi-stage encryption process for the raw customer transaction data during transmission, without prior anonymization. Option C. Share the raw, identifiable customer transaction data directly with the regulatory authority, relying on their internal security protocols for protection. Option D. Request an exemption from submitting the detailed data, citing customer privacy concerns, and provide only aggregated, non-identifiable summaries. The correct answer is A. Anonymize or pseudonymize the customer transaction data to remove or obscure personally identifiable information before sharing it with the regulatory authority. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the bank to balance its obligation to protect customer data with the need to comply with regulatory reporting requirements. The challenge lies in identifying and implementing a process that is both secure and efficient, ensuring that sensitive information is not compromised while still meeting statutory deadlines. The potential for data breaches or regulatory penalties necessitates careful judgment and a robust approach. Correct approach analysis. The correct approach, which involves anonymizing or pseudonymizing customer data before sharing it with the regulatory authority, represents best professional practice because it directly addresses the dual requirements of data protection and regulatory compliance. Anonymization, removing all identifying information, or pseudonymization, replacing identifying information with artificial identifiers, significantly reduces the risk of re-identification, thereby safeguarding customer privacy. This aligns with the principles of data minimization and purpose limitation often enshrined in banking regulations and data protection laws in India, such as the Digital Personal Data Protection Act, 2023, which emphasizes consent and lawful processing of personal data. By adopting this method, the bank demonstrates a commitment to ethical data handling and adherence to regulatory mandates without exposing sensitive customer details unnecessarily. Incorrect approaches analysis. Sharing raw, identifiable customer data directly with the regulatory authority, even with the stated purpose of compliance, represents a significant regulatory and ethical failure. This approach violates the principles of data privacy and confidentiality, potentially exposing customers to identity theft or misuse of their personal information. It contravenes the spirit and letter of data protection laws that mandate secure handling and limited disclosure of personal data. Such an action could lead to severe penalties, reputational damage, and loss of customer trust. Implementing a complex, multi-stage encryption process for data transmission without prior anonymization or pseudonymization is also an inadequate approach. While encryption protects data in transit, it does not address the fundamental issue of sharing raw, identifiable data. If the encrypted data were somehow compromised, the sensitive information would still be exposed. Furthermore, the complexity might introduce operational risks and delays, potentially impacting timely regulatory reporting. This approach fails to adequately mitigate the risk of data exposure at the source. Relying solely on the regulatory authority's internal security protocol to protect raw customer data is a passive and unacceptable approach. The bank has an independent duty of care to protect its customers' data. Outsourcing this responsibility entirely to another entity without implementing its own protective measures like anonymization or pseudonymization is a dereliction of duty. It fails to proactively manage the risk of data exposure and places undue reliance on third-party assurances, which may not always be sufficient or verifiable. Professional reasoning. Professionals should adopt a proactive risk management framework. This involves first identifying the sensitive nature of the data, understanding the specific regulatory requirements for reporting, and then evaluating various methods to meet these requirements while minimizing risk. The decision-making process should prioritize data privacy and security, seeking solutions that achieve compliance without compromising customer confidentiality. This often involves consulting with legal, compliance, and IT security teams to select the most appropriate and secure method, such as data anonymization or pseudonymization, before any data is shared. Question 3. The audit findings indicate that the bank's operational risk management framework has certain deficiencies, particularly in the consistent identification and assessment of emerging risks and the effectiveness of existing mitigation strategies. Management is considering several approaches to address these findings. Which approach best aligns with the Reserve Bank of India's regulatory expectations for sound risk management practices? Option A. Implement a comprehensive review of the entire operational risk management framework, including a reassessment of risk appetite, enhancement of risk identification processes, and strengthening of control mechanisms, with a clear action plan and timelines for remediation. Option B. Focus on updating the documentation of current operational risk processes to reflect existing practices, without undertaking significant changes to the underlying control environment. Option C. Address only the most critical audit points that have immediate visibility, while postponing the review of less apparent but potentially significant risk areas. Option D. Prioritize the reduction of operational risk-related expenses by streamlining risk management functions, even if it means deferring the implementation of certain recommended control enhancements. The correct answer is A. Implement a comprehensive review of the entire operational risk management framework, including a reassessment of risk appetite, enhancement of risk identification processes, and strengthening of control mechanisms, with a clear action plan and timelines for remediation. Explanation. This scenario presents a professional challenge because the audit findings highlight potential noncompliance with the Reserve Bank of India's (RBI) guidelines on risk management and internal controls, specifically concerning the identification and mitigation of operational risks. The bank's management is tasked with evaluating different approaches to address these findings, requiring a nuanced understanding of regulatory expectations and best practices in risk management. Careful judgment is essential to ensure that the chosen approach not only rectifies the immediate issues, but also strengthens the bank's overall risk governance framework, aligning with the RBI's mandate for sound banking practices. The correct approach represents best professional practice because it directly addresses the root cause of the audit findings by implementing a robust, forward-looking risk assessment and mitigation plan. This aligns with RBI's emphasis on a proactive and comprehensive approach to operational risk management, as outlined in various circulars and master directions. It demonstrates a commitment to continuous improvement and adherence to regulatory expectations for maintaining financial stability and protecting customer interests. This approach prioritizes a systematic review, enhancement of internal controls, and integration of risk management into business processes, which are fundamental to sound banking operations. An incorrect approach that focuses solely on documenting existing processes without substantive improvements fails to address the identified control weaknesses. This would be a regulatory failure, as it does not demonstrate a genuine effort to comply with RBI's requirement for effective risk mitigation. It also represents an ethical failure, as it misrepresents the bank's risk management capabilities to regulators and stakeholders. Another incorrect approach that prioritizes immediate cost reduction over comprehensive risk remediation would be a significant regulatory and ethical failure. The RBI expects banks to invest adequately in risk management infrastructure and processes. Prioritizing short-term financial gains at the expense of robust risk controls undermines the bank's safety and soundness, potentially leading to larger losses in the future and violating the fiduciary duty owed to depositors and shareholders. A third incorrect approach that involves selectively addressing only the most visible audit points without a holistic review would also be a regulatory failure. The RBI's guidelines emphasize a comprehensive and integrated approach to risk management. Superficial fixes do not build resilience and can leave the bank vulnerable to other, unaddressed risks. This approach demonstrates a lack of commitment to the spirit of regulatory compliance. The professional decision-making process for similar situations should involve 1. Thoroughly understanding the audit findings and their implications for the bank's risk profile. 2. Consulting relevant RBI guidelines and circulars pertaining to operational risk management, internal controls, and audit requirements. 3. Evaluating potential solutions against these regulatory expectations and best practices in risk management. 4. Prioritizing actions that address the root causes of identified weaknesses and contribute to a sustainable improvement in the risk management framework. 5. Ensuring that the chosen approach is practical, cost-effective in the long term, and aligns with the bank's strategic objectives while upholding ethical standards. 6. Documenting the rationale for the chosen approach and the expected outcomes, and establishing mechanisms for ongoing monitoring and review. Question 4. Investigation of a bank employee's discovery of a client's unusual and potentially large cash deposit, coupled with a vague explanation from the client regarding its source, necessitates a careful and compliant response. Considering the State Bank of India's regulatory obligations under Indian law, which of the following actions best represents the most appropriate and professional course of conduct for the employee? Option A. Discuss the client's transaction and the employee's suspicions with a trusted colleague in another department to seek their opinion. Option B. Immediately report the suspicious transaction to the bank's designated compliance department for further review and action. Option C. Directly question the client about the source of the funds to clarify the situation before taking any further steps. Option D. File the information away as routine and not of significant concern, given the client's long-standing relationship with the bank. The correct answer is B. Immediately report the suspicious transaction to the bank's designated compliance department for further review and action. Explanation. Scenario analysis. This scenario presents a professional challenge where a bank employee, acting in good faith, receives information that could potentially impact a client's financial standing. The challenge lies in balancing the bank's duty of confidentiality towards its clients with the imperative to comply with regulatory reporting obligations, particularly concerning potential financial irregularities. Misinterpreting or mishandling such information can lead to significant regulatory penalties, reputational damage, and erosion of client trust. The employee must exercise sound judgment and adhere strictly to established protocols. Correct approach analysis. The correct approach involves immediately escalating the information to the designated compliance department or the appropriate internal authority within State Bank of India. This aligns with the principles of robust internal controls and regulatory compliance mandated by Indian banking regulations. The Reserve Bank of India, RBI, guidelines, such as those pertaining to Know Your Customer (KIC) norms, anti-money laundering (AML), and combating the financing of terrorism (CFT), emphasize the importance of reporting suspicious transactions or activities. By escalating, the employee ensures that the information is reviewed by trained professionals who can assess its materiality and initiate necessary actions, including potential reporting to regulatory bodies, in accordance with the Banking Regulation Act, 1949, and other relevant circulars. This upholds the bank's commitment to financial integrity and regulatory adherence. Incorrect approaches analysis. One incorrect approach involves directly contacting the client to inquire about the information. This violates the bank's duty of confidentiality and could alert the client to a potential investigation, allowing them to conceal or destroy evidence. It also bypasses the bank's established compliance procedures, which are designed to ensure objective assessment and appropriate action. This could be seen as a breach of fiduciary duty and potentially contravene provisions related to customer data privacy. Another incorrect approach is to ignore the information, assuming it is not significant. This failure to act is a direct contravention of the bank's obligation to maintain vigilance against financial crimes and irregularities. Indian banking regulations, particularly those related to suspicious transaction reporting (STR), under the Prevention of Money Laundering Act, 2002, mandate that all suspicious activities must be reported. Ignoring such information can lead to severe penalties for the bank and the individual employee, including fines and disciplinary action. A third incorrect approach is to discuss the information with colleagues who are not directly involved in compliance or the client's account management. This constitutes a breach of confidentiality and could lead to the unauthorized dissemination of sensitive client information, creating a risk of insider trading or other malpractices. It undermines the integrity of internal information handling protocols and could expose the bank to legal and reputational risks. Professional reasoning. Professionals in banking must adopt a proactive and protocol-driven approach when encountering potentially sensitive information. The decision-making process should involve 1. Recognizing the potential regulatory or ethical implications of the information. 2. Consulting internal policies and procedures for guidance. 3. Escalating the matter to the appropriate internal authority e.g., compliance, legal, or risk management without delay. 4. Avoiding direct engagement with the client or unauthorized disclosure of information. This systematic approach ensures that all actions are compliant with Indian banking laws and ethical standards, safeguarding both the client's interests and the bank's integrity. Question 5. What factors determine the most effective strategy for implementing a new digital banking platform at State Bank of India, considering the Reserve Bank of India's guidelines on cybersecurity, data privacy, and customer grievance redressal? Option A. Implementing the platform with minimal upfront investment in training and security, relying on external vendors for immediate support. Option B. Launching the platform with basic functionalities and gradually introducing advanced features based on market demand, without extensive pre-launch customer feedback. Option C. Focusing on rapid deployment to gain first-mover advantage, with post-launch updates for security and customer support. Option D. Prioritizing a phased rollout with comprehensive testing, robust cybersecurity measures, thorough employee training, and a clear customer communication strategy. The correct answer is D. Prioritizing a phased rollout with comprehensive testing, robust cybersecurity measures, thorough employee training, and a clear customer communication strategy. Explanation. The scenario presents a challenge in implementing a new digital banking platform within State Bank of India, SBI. This involves navigating the complexities of regulatory compliance, technological integration, and customer adoption, all while ensuring the security and integrity of financial transactions. The professional challenge lies in balancing innovation with the stringent requirements of the Reserve Bank of India, RBI, guidelines, particularly concerning data privacy, cybersecurity, and customer grievance redressal mechanisms. Careful judgment is required to ensure the platform not only meets business objectives, but also upholds the trust and confidence of customers and regulators. The correct approach focuses on a phased rollout strategy, prioritizing robust testing, comprehensive employee training, and a clear communication plan for customers. This represents best professional practice because it aligns with RBI's emphasis on operational risk management and customer protection. A phased approach allows for early identification and mitigation of technical glitches, ensuring a smoother transition and minimizing disruption to services. Thorough testing and training are critical for preventing data breaches and ensuring compliance with cybersecurity mandates. A clear communication strategy fosters customer trust and facilitates adoption, addressing potential concerns proactively. This approach demonstrates a commitment to responsible innovation and adherence to regulatory frameworks like the Digital India Initiative and RBI's guidelines on IT risk management and outsourcing. An incorrect approach that focuses solely on rapid deployment, without adequate testing and security audits, would represent a significant regulatory and ethical failure. This would violate RBI's cybersecurity directives and potentially expose customer data to breaches, leading to severe penalties and reputational damage. Another incorrect approach, neglecting comprehensive employee training on the new platform's functionalities and security protocols, would increase the risk of human error, leading to operational inefficiencies and compliance breaches. Failing to establish a clear and accessible customer grievance redressal mechanism for the new platform would contravene RBI's customer service guidelines and erode customer confidence. The professional decision-making process for similar situations should involve a thorough risk assessment, identifying potential regulatory, operational, and reputational risks associated with the implementation. This should be followed by the development of a detailed project plan that incorporates robust testing, security measures, and employee training. Stakeholder engagement, including regular communication with regulatory bodies, is crucial. A contingency plan should also be in place to address unforeseen issues. Prioritizing customer experience and data security throughout the implementation lifecycle is paramount, ensuring that all decisions are aligned with ethical principles and regulatory requirements. Question 6. When evaluating a new customer's application for a savings account and facing pressure from the sales team to expedite the process due to a high-value client, which of the following actions best adheres to the Reserve Bank of India's (RBI) regulatory framework for Know Your Customer (KIC) and anti-money laundering (AML? Option A. Obtain and verify the customer's Aadhaar card and PAN card and conduct a video-based identification process (VSIP) to confirm their identity and address as per RBI guidelines. Option B. Expedite the account opening using a temporary identification document that is not a primary KYC document, as the client is in a hurry. Option C. Waive the requirement for a PAN card for this high-value account, as the client is a prominent individual and has provided other forms of identification. Option D. Accept the customer's self-declaration of address, even if they are a known client of another branch, without independent verification of the current address. The correct answer is A. Obtain and verify the customer's Aadhaar card and PAN card and conduct a video-based identification process, VSIP, to confirm their identity and address as per RBI guidelines. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for efficient internal processes with the imperative of adhering to the Reserve Bank of India's (RBI) guidelines on Know Your Customer (KIC) and anti-money laundering (AML) for new account opening. The pressure to meet targets can lead to shortcuts, but any deviation from prescribed KYC norms can expose the bank to significant regulatory penalties, reputational damage, and facilitate illicit financial activities. The core challenge lies in ensuring robust customer due diligence without unduly hindering legitimate business. Correct approach analysis. The correct approach involves prioritizing a thorough verification of the customer's identity and address as per the RBI's master directions on KYC. This includes obtaining and verifying the stipulated documents e.g., Aadhaar, PAN, utility bills, and where applicable, conducting in-person verification or video-based identification process, VSIP, as permitted by the RBI. This aligns directly with the RBI's objective of preventing the bank from being used for money laundering or terrorist financing, thereby upholding the integrity of the financial system and ensuring compliance with the Prevention of Money Laundering Act, 2002, and subsequent RBI circulars. Incorrect approaches analysis. One incorrect approach involves accepting a customer's self-declaration of address without any independent verification, even if the customer is a long-standing client of another branch. This fails to meet the RBI's requirement for independent verification of address proof, as a change of address might not have been updated in the other branch's records, or the self-declaration could be fraudulent. This exposes the bank to risks of non-compliance with KYC norms. Another incorrect approach is to expedite account opening by relying solely on a temporary identification document that is not explicitly listed as a valid KYC document by the RBI for permanent account opening. While it might serve as a temporary identifier, it does not fulfill the stringent requirements for establishing a customer's identity and address for regulatory purposes, potentially leading to accounts being opened for individuals who do not meet the bank's or regulator's standards. A third incorrect approach is to waive the requirement for a permanent account number (PAN card) for a high-value account, citing a high-profile customer's status. The RBI mandates PAN for most financial transactions and account openings to track financial activities and prevent tax evasion. Waiving this requirement, regardless of the customer's profile, is a direct contravention of RBI directives and facilitates potential financial irregularities. Professional reasoning. Professionals should adopt a risk-based approach to customer due diligence. This involves understanding the RBI's KYC/AML guidelines thoroughly and applying them consistently. When faced with pressure to expedite processes, the professional decision-making framework should involve 1. identifying the specific regulatory requirements for the transaction or service. 2. Assessing the risks associated with any proposed deviation from these requirements. 3. Consulting with compliance officers or supervisors if there is any ambiguity or pressure to bypass established procedures. 4. Prioritizing regulatory compliance and customer due diligence over short-term business targets to maintain the bank's integrity and avoid penalties. Question 7. The evaluation methodology shows a new digital customer onboarding platform is being rolled out by the bank. The project manager is under pressure to launch quickly to gain a competitive edge. They are considering streamlining the document verification process by accepting scanned copies of identity proofs without real-time validation against official databases, arguing that manual checks will be performed later. What is the most appropriate course of action for the project manager to ensure regulatory compliance and best professional practice? Option A. Halt the rollout and conduct a thorough review of the proposed verification process against all applicable RBI guidelines for customer identification and verification, seeking explicit approval from the compliance department before proceeding. Option B. Proceed with the streamlined verification process as planned, assuming that the existing manual verification framework is sufficient for the digital age and will adequately address any potential compliance issues. Option C. Implement the new platform with a streamlined verification process, relying on subsequent manual checks to catch any discrepancies and document the risk mitigation strategy. Option D. Launch the platform with the streamlined verification process and immediately initiate a retrospective audit to identify and rectify any compliance gaps that may arise. The correct answer is C. Implement the new platform with the streamlined verification process, relying on subsequent manual checks to catch any discrepancies and document the risk mitigation strategy. Explanation. The evaluation methodology shows a scenario where a bank employee is tasked with implementing a new customer onboarding process. This scenario is professionally challenging because it requires balancing efficiency with strict adherence to regulatory requirements, particularly concerning Know Your Customer (KIC) and anti-money laundering (AML) norms as stipulated by Indian banking regulations. The employee must ensure the new process is not only user-friendly, but also robust enough to prevent financial crimes and comply with the Reserve Bank of India's RBI directives. The correct approach involves a phased implementation with thorough testing and validation against existing regulatory frameworks. This represents best professional practice because it minimizes the risk of noncompliance, which could lead to significant penalties, reputational damage, and operational disruptions. It allows for early identification and rectification of any gaps in the process that might violate KYC/AML guidelines or data privacy regulations. This systematic approach ensures that the new process is aligned with the spirit and letter of the law, safeguarding both the bank and its customers. An incorrect approach would be to prioritize speed of implementation over regulatory compliance. For instance, bypassing certain verification steps to expedite customer onboarding would be a direct violation of RBI's KYC/AML guidelines. This creates a significant ethical and regulatory failure, exposing the bank to risks of facilitating illicit financial activities. Another incorrect approach would be to assume that existing manual checks are sufficient for the new digital process without explicit validation. This overlooks the potential for new vulnerabilities introduced by automation and digital channels, failing to meet the due diligence standards mandated by regulators. A third incorrect approach might be to implement the new process without adequate training for staff on the updated compliance requirements, leading to unintentional breaches. The professional decision-making process for similar situations should involve a risk-based assessment. Before implementation, a comprehensive review of the proposed process against all applicable banking laws and RBI circulars is essential. This should include a gap analysis to identify any deviations from regulatory expectations. Stakeholder consultation, including legal and compliance departments, is crucial. Pilot testing in a controlled environment, followed by a gradual rollout, allows for continuous monitoring and adjustment. Any new process must be documented thoroughly, with clear audit trails and mechanisms for ongoing compliance monitoring. Question 8. Market research demonstrates a significant opportunity for a new digital lending product that leverages advanced analytics for credit scoring. The product development team is eager to launch within 6 months to capture market share. However, the product will collect and process sensitive customer financial data. What is the most prudent approach to ensure compliance with Reserve Bank of India (RBI) regulations regarding data privacy and IT risk management? Option A. Proceed with the launch as scheduled, relying on the bank's existing IT security infrastructure and general data anonymization practices. Option B. Defer the full security control validation until after the product has been launched to meet the market timeline, with a plan to address any identified issues subsequently. Option C. Prioritize the market launch and conduct a post-launch review of data privacy and security controls within the first quarter after release. Option D. Conduct a comprehensive data privacy impact assessment (DPIA) and validate all security controls for the new product before its full-scale launch. The correct answer is D. Conduct a comprehensive data privacy impact assessment (DPIA) and validate all security controls for the new product before its full-scale launch. Explanation: Scenario analysis. This scenario presents a common challenge in banking operations where a new product launch, while promising market growth, introduces potential risks related to customer data privacy and compliance with the Reserve Bank of India's (RBI) guidelines. The pressure to meet aggressive timelines for product rollout can often lead to overlooking critical regulatory checkpoints, making careful judgment and a risk-aware approach paramount. The challenge lies in balancing innovation and market opportunity with the imperative of safeguarding customer information and adhering to legal mandates. Correct approach analysis. The correct approach involves a phased implementation strategy that prioritizes a comprehensive data privacy impact assessment (DPIA) and robust security control validation before the full-scale launch. This aligns with the spirit and letter of RBI's Master Direction on IT risk management and data localization, which mandates that banks assess and mitigate risks associated with new technologies and data handling practices. A DPIA ensures that potential privacy risks are identified and addressed proactively, and security control validation confirms that the product meets the bank's security standards and regulatory requirements. This approach demonstrates best professional practice by embedding compliance and risk management into the product development lifecycle, thereby protecting customer trust and avoiding potential regulatory penalties. Incorrect approach is analysis. One incorrect approach involves proceeding with the launch without a formal DPIA, relying solely on the IT department's general security protocols. This fails to specifically address the privacy implications of the new product's data collection and processing, potentially violating RBI's emphasis on data protection and customer consent. It represents a significant regulatory and ethical failure by not conducting a required risk assessment. Another incorrect approach is to defer the full security control validation until after the product has been launched to meet the market timeline. This is a direct contravention of prudent risk management principles and RBI's guidelines, which expect proactive security measures. Launching a product with unvalidated security controls exposes the bank and its customers to significant risks of data breaches, reputational damage, and regulatory sanctions. A third incorrect approach is to assume that existing data anonymization techniques are sufficient without a specific review for the new product's data types. While anonymization is a valid technique, its effectiveness is context-dependent. Failing to conduct a specific assessment for the new product could lead to re-identification risks, thereby violating the principles of data minimization and purpose limitation as espoused by data protection regulations. Professional reasoning. Professionals should adopt a risk-based approach, integrating compliance and security considerations from the outset of any new product development. This involves establishing clear internal policies and procedures that mandate pre-launch assessments for data privacy and security. When faced with competing pressures, professionals must advocate for adherence to regulatory requirements, clearly articulating the potential consequences of noncompliance. A structured decision-making process would involve 1. Identifying all applicable regulations, e.g., RBI guidelines on data privacy, IT risk management. 2. Conducting a thorough risk assessment, including a DPIA. 3. Developing and validating appropriate mitigation strategies. 4. Obtaining necessary approvals from compliance and risk management departments before launch. 5. Establishing post-launch monitoring mechanisms. Question 9. Stakeholder feedback indicates that the current customer onboarding process at State Bank of India is perceived as too slow, potentially leading to lost business opportunities. Management is considering streamlining the process by reducing the number of mandatory documents for certain customer segments and expediting the verification of source of funds for low-risk individuals. However, Compliance Department has raised concerns about potential breaches of Know Your Customer (KIC) and anti-money laundering (AML) regulations. Which of the following approaches best balances the need for operational efficiency with regulatory compliance? Option A. Outsource the entire KYC verification process to an external vendor without establishing a comprehensive oversight framework to monitor the vendor's compliance with regulatory standards. Option B. Completely waive enhanced due diligence requirements for all high net worth individuals to expedite their onboarding and secure their business quickly. Option C. Implement a phased onboarding process where essential documentation is collected upfront for immediate account opening, with a clear timeline for submitting remaining verification documents and completing enhanced due diligence for high-risk clients. Option D. Rely solely on customer self-declarations regarding the source of funds for all new account openings, without any independent verification, to speed up the process. The correct answer is C. Implement a phased onboarding process where essential documentation is collected upfront for immediate account opening, with a clear timeline for submitting remaining verification documents and completing enhanced due diligence for high-risk clients. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for robust internal controls with the operational efficiency required to meet market demands. The pressure to expedite the onboarding process, driven by competitive pressures and potential revenue loss, can lead to shortcuts that compromise compliance. The core challenge lies in identifying and mitigating risks associated with inadequate due diligence without unduly hindering legitimate business activities. This requires a nuanced understanding of the regulatory landscape and the bank's risk appetite. Correct approach analysis. The correct approach prioritizes adherence to the Know Your Customer (KIC) and anti-money laundering (AML) regulations as mandated by the Reserve Bank of India (RBI). Specifically, it aligns with the principles outlined in the Prevention of Money Laundering Act, 2002, and subsequent RBI circulars. These regulations require banks to conduct thorough due diligence on customers to prevent financial crimes, implementing a phased approach to onboarding, where essential documentation is collected upfront and further verification is completed within a defined, reasonable timeframe, strikes a balance between efficiency and compliance. This demonstrates a commitment to regulatory requirements while acknowledging the need for a streamlined process. It ensures that, while initial access is granted, the bank maintains its obligation to fully understand its customer and their transaction, thereby mitigating risks of financial crime. Incorrect approaches analysis. One incorrect approach involves completely bypassing enhanced due diligence (ED) for high-risk clients to speed up onboarding. This directly violates RBI guidelines that mandate EDD for such clients, increasing the bank's exposure to money laundering and terrorist financing risks. It demonstrates a disregard for regulatory obligations and a failure to implement adequate risk management frameworks. Another incorrect approach is to rely solely on self-declaration from clients regarding their source of funds, without any independent verification for certain categories of clients. This is a significant breach of KYC norms, as it fails to establish the legitimacy of the funds, thereby opening avenues for illicit financial activities. It undermines the very purpose of due diligence. A third incorrect approach is to delegate the entire KYC verification process to third-party vendors without establishing a robust oversight mechanism and ensuring the vendor's adherence to the bank's internal policies and regulatory requirements. While outsourcing can be efficient, the ultimate responsibility for compliance rests with the bank. Lack of oversight can lead to compromised verification standards and regulatory noncompliance. Professional reasoning. Professionals in the banking sector must adopt a risk-based approach to customer onboarding. This involves understanding the specific regulatory requirements of the Reserve Bank of India, assessing the risk profile of each customer, and implementing appropriate due diligence measures accordingly. When faced with competing pressures, the decision-making process should involve 1. Identifying the relevant regulations and internal policies. 2. Assessing the potential risks associated with each proposed action. 3. Evaluating the impact on operational efficiency and customer experience. 4. Consulting with compliance and legal departments when in doubt. 5. prioritizing regulatory compliance and risk mitigation over short-term gains. Question 10. The assessment process reveals a critical security vulnerability in the new customer onboarding system, potentially exposing sensitive customer data during the integration phase. The project deadline is imminent, and the IT team is under pressure to go live. The head of operations is advocating for a swift integration, suggesting the IT team can patch it on the fly to meet the deadline, while the Chief Information Security Officer, CISO, is recommending an immediate halt to the integration for a thorough forensic analysis. Which of the following actions best represents the most professional and compliant approach in this situation, considering the regulatory framework governing State Bank of India? Option A. Proceed with the integration as planned, instructing the IT team to implement immediate patches to address the vulnerability during the live operation. Option B. Defer the security concern until after the system goes live, assuming the risk is minimal and can be addressed in a subsequent update. Option C. Roll back the entire integration process to the previous stable version and postpone the launch indefinitely until a completely secure system is developed. Option D. Halt the integration immediately and initiate a comprehensive forensic analysis to identify and rectify the vulnerability before proceeding. The correct answer is D. Halt the integration immediately and initiate a comprehensive forensic analysis to identify and rectify the vulnerability before proceeding. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for efficient data processing with the imperative of adhering to the Reserve Bank of India's RBI guidelines on data privacy and security for financial institutions. The pressure to quickly integrate a new customer onboarding system, coupled with the discovery of potential data leakage, creates a conflict between operational expediency and regulatory compliance. A hasty decision could lead to significant penalties, reputational damage, and erosion of customer trust. Correct approach analysis. The correct approach prioritizes immediate containment and thorough investigation, aligning with the RBI's Master Direction Information Technology Risk Management. This direction mandates robust data security measures and incident response protocols. By halting the integration and initiating a forensic analysis, the bank demonstrates a commitment to identifying the root cause of the vulnerability and rectifying it before any further data compromise occurs. This proactive stance is crucial for maintaining the integrity of customer data and adhering to the principle of security by design. Incorrect approaches analysis. One incorrect approach involves proceeding with the integration while simultaneously attempting to patch the system. This is a high-risk strategy that violates the principle of containing a potential breach before further exposure. The RBI's guidelines emphasize a structured incident response, which typically involves isolation and assessment before remediation. Continuing the integration could exacerbate the data leakage, making it harder to track and mitigate. Another incorrect approach is to ignore the alert and assume it's a false positive due to time constraints. This is a direct contravention of the bank's duty of care and the RBI's expectations for vigilance. Ignoring such alerts can lead to severe data breaches, resulting in substantial fines under the Information Technology Act, 2000, and its subsequent amendments, as well as reputational damage. A third incorrect approach is to immediately escalate to a full system rollback without a proper assessment. While a rollback might seem like a safe option, it can be disruptive and may not be necessary if the vulnerability is localized and can be patched effectively. A measured response, starting with investigation, is more aligned with efficient risk management and operational continuity, as expected by regulatory bodies. Professional reasoning. When faced with a potential data security incident, a financial professional should follow a structured decision-making process. First, assess the immediate risk and potential impact. Second, consult relevant internal policies and external regulatory guidelines, in this case, RBI directives. Third, prioritize containment and investigation to understand the scope of the issue. Fourth, develop and implement a remediation plan based on the findings. Finally, document the entire process and conduct a post-incident review to prevent recurrence. This systematic approach ensures compliance, protects customer data, and upholds the institution's integrity. Question 11. The control framework reveals a proposed digital onboarding process for new savings account customers at State Bank of India that relies heavily on self-declared information and a single form of digital identification. This approach aims to expedite customer acquisition in a competitive market. considering the regulatory landscape governed by the Reserve Bank of India (RBI) and the Prevention of Money Laundering Act (PMLA). Which of the following implementation strategies best balances regulatory compliance with operational efficiency? Option A. Utilize customer self-attestation for all information and accept any form of digital identification provided by the customer, assuming the digital signature validates the authenticity of the submitted data. Option B. Introduce a simplified digital onboarding process that bypasses several standard verification steps, prioritizing customer acquisition targets over comprehensive identity checks. Option C. Proceed with the proposed digital onboarding process as is, focusing on speed and ease of use, with the understanding that manual checks will be performed on a sample basis for a limited number of accounts. Option D. Implement a multi-layered verification system that includes biometric authentication, secure digital document verification, and enhanced due diligence for high-risk customer profiles, while continuously monitoring for suspicious activities. The correct answer is D. Implement a multi-layered verification system that includes biometric authentication, secure digital document verification, and enhanced due diligence for higher-risk customer profiles, while continuously monitoring for suspicious activities. Explanation. The control framework reveals a potential gap in the implementation of the Know Your Customer (KIC) and anti-money laundering (AML) policies within a new digital onboarding process at State Bank of India. The challenge lies in balancing the need for robust customer verification to prevent financial crime with the imperative to provide a seamless and efficient customer experience, especially in a rapidly evolving digital landscape. The scenario is professionally challenging because it requires a nuanced understanding of regulatory expectations, technological capabilities, and customer expectations. A misstep could lead to regulatory penalties, reputational damage, or a loss of competitive advantage. The correct approach represents best professional practice because it prioritizes a risk-based methodology, aligning with the Reserve Bank of India's (RBI) guidelines on KYC and AML. This approach involves implementing multiple layers of verification, including biometric authentication and document verification through secure channels, while also allowing for enhanced due diligence for high-risk customers. This demonstrates a commitment to regulatory compliance and financial integrity, which are paramount for a public sector bank like SBI. It also acknowledges the need for continuous monitoring and adaptation of controls in response to emerging threats and technological advancements, ensuring the long-term effectiveness of the onboarding process. An incorrect approach that relies solely on basic document submission, without further verification, fails to meet the minimum regulatory requirements for customer identification and verification. This exposes the bank to significant risks of money laundering and terrorist financing, leading to potential penalties under the Prevention of Money Laundering Act, PMLA, and other relevant RBI circulars. Another incorrect approach that overlies on customer self-attestation without independent verification, even with digital signatures, is similarly deficient. While digital signatures are legally recognized, they do not inherently guarantee the identity of the individual providing them, especially in the context of high-risk financial transactions. This approach would be a violation of the principle of knowing your customer and could lead to the onboarding of shell companies or individuals involved in illicit activities. A third incorrect approach that prioritizes speed over security by bypassing certain verification steps for expediency would be a direct contravention of the spirit and letter of KYC/AML regulations, demonstrating a disregard for the bank's fiduciary responsibilities and the integrity of the financial system. Professional reasoning in such situations requires a structured approach. First, thoroughly understand the specific regulatory requirements and guidelines issued by the RBI concerning KYC, AML, and digital onboarding. Second, conduct a comprehensive risk assessment of the proposed digital onboarding process, identifying potential vulnerabilities and the likelihood and impact of associated risks. Third, evaluate available technological solutions and their ability to meet both regulatory demands and customer experience objectives. Fourth, consult with legal and compliance departments to ensure the chosen approach is robust and defensible. Finally, establish a framework for ongoing monitoring, review, and adaptation of the control measures to address evolving risks and regulatory changes. Question 12. The performance metrics show a significant dip in the number of new investment product sales for your team over the last quarter, despite consistent client engagement. Your branch manager suggests that to boost these numbers before the annual review, the team should focus on repackaging existing client portfolios to appear as new sales, even if the underlying investments are largely unchanged. The manager emphasizes that this is a common practice to meet targets and that a little flexibility is expected. Option A. Proceed with the manager's suggestion to repackage portfolios, focusing on highlighting minor changes to create the appearance of new sales, as this is a common practice to meet targets and maintain team performance. Option B. Repackage a small number of client portfolios as suggested to demonstrate willingness to meet targets, while discreetly documenting the manager's instructions and the nature of the repackaging for future reference. Option C. Refuse to participate in any repackaging of client portfolios that misrepresents the nature of the sales and escalate the concern to the compliance department, citing potential violations of fair dealing and transparency principles. Option D. Discuss the performance dip with the manager and suggest alternative ethical strategies to increase sales, such as enhanced client education on new product benefits, while politely declining the repackaging suggestion. The correct answer is C. Refuse to participate in any repackaging of client portfolios that misrepresents the nature of the sales and escalate the concern to the compliance department, citing potential violations of fair dealing and transparency principles. Explanation. This scenario presents a professional challenge because it pits the immediate pressure to meet performance targets against the fundamental ethical obligation to act in the best interest of the client and uphold the integrity of the bank. The temptation to misrepresent information or push unsuitable products to achieve personal or team goals is a common ethical pitfall in financial services. Careful judgment is required to navigate this conflict, prioritizing long-term client trust and regulatory compliance over short-term gains. The correct approach, which involves escalating the concern through appropriate channels and refusing to engage in misrepresentation, represents best professional practice. This aligns with the State Bank of India's Code of Conduct and relevant banking regulations, which mandate honesty, transparency, and a fiduciary duty towards clients. By raising the issue, the employee upholds their professional integrity, protects the client from potential harm, and safeguards the bank's reputation. This proactive stance demonstrates adherence to ethical principles and regulatory expectations for responsible banking. An incorrect approach of overlooking the discrepancies or subtly manipulating the data to meet targets would constitute a serious ethical and regulatory failure. This would violate principles of honesty and fair dealing, potentially leading to client dissatisfaction, financial loss for the client, and regulatory penalties for the bank. Furthermore, such actions erode trust within the organization and undermine the ethical culture. Another incorrect approach, that of directly confronting the manager without proper documentation or escalation, could be counterproductive and lead to personal repercussions without effectively addressing the systemic issue. It lacks the structured approach required for effective resolution and compliance. Professionals should employ a decision-making framework that begins with identifying the ethical conflict. This involves recognizing the pressure to meet targets versus the obligation to act ethically. The next step is to gather facts and assess the situation objectively. Then, consider the relevant ethical principles and regulatory requirements. The professional should then explore available options, evaluating each against ethical standards and potential consequences. Finally, the decision should be made to act in a manner that upholds integrity, protects stakeholders, and complies with regulations, even if it means facing short-term discomfort or challenging superiors. Escalation through defined channels is a crucial part of this process when direct resolution is not feasible or appropriate. Question 13. Risk assessment procedures indicate that a long-standing client, known for their conservative investment approach and limited risk tolerance, is expressing interest in a new investment product that offers significantly higher commissions to the bank's financial advisors. The product, however, carries a higher risk profile than the client has historically been comfortable with. The advisor is aware that the client's current financial situation and stated objectives do not align with the inherent risks of this product. What is the most appropriate course of action for the financial advisor? Option A. Inform the client about the higher commission associated with the product and suggest they might want to consider it if they are willing to accept the associated risks. Option B. Immediately escalate the situation to the branch manager, highlighting the potential revenue opportunity but also the client's conservative nature. Option C. Proceed with recommending the high commission product, emphasizing its potential for higher returns, and suggesting the client consider taking on a slightly higher level of risk to benefit from it. Option D. Conduct a thorough reassessment of the client's risk profile and financial objectives to determine if the new product, with appropriate disclosures, could genuinely be suitable, or if alternative, more suitable products should be recommended. The correct answer is D. Conduct a thorough reassessment of the client's risk profile and financial objectives to determine if the new product, with appropriate disclosures, could genuinely be suitable, or if alternative, more suitable products should be recommended. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in the potential conflict between a client's immediate financial needs and the bank's ethical obligations to ensure suitability and prevent financial harm. The relationship with a long-standing client adds a layer of complexity, as maintaining trust is paramount. However, the advisor's duty of care and adherence to regulatory guidelines regarding product suitability and risk profiling supersede personal relationships or the desire to meet sales targets. The pressure to generate revenue, even implicitly, can cloud judgment, making it crucial to rely on established ethical frameworks and regulatory mandates. Correct approach analysis. The correct approach involves a thorough reevaluation of the client's risk profile and financial objectives. This aligns with the principles of Know Your Customer (KIC) and suitability, which are fundamental to banking regulations in India. The Reserve Bank of India (RBI) guidelines emphasize that financial products must be suitable for the client's needs, risk tolerance, and investment horizon. By proposing a product that is demonstrably aligned with these factors, even if it means a lower commission, the advisor upholds their fiduciary duty and regulatory compliance. This approach prioritizes client well-being and long-term trust over short-term gains, reflecting best professional practice. Incorrect approach is analysis. Proposing the high-commission product without a revised risk assessment is a direct violation of suitability regulations. It prioritizes the advisor's commission over the client's financial security, constituting a breach of ethical conduct and potentially mis-selling. This could lead to regulatory penalties, reputational damage, and loss of client trust. Suggesting the client take on more risk to fit the product is unethical and potentially illegal. It involves manipulating the client's understanding of risk and pressuring them into an unsuitable investment. This undermines the integrity of the financial advisory process and contravenes the spirit of consumer protection laws. Escalating the issue to a manager without first attempting to find a suitable solution for the client demonstrates a lack of personal responsibility and problem-solving initiative. While escalation might be necessary in some cases, it should not be the first resort when a client's best interests can be served through diligent professional effort. This approach could be seen as avoiding responsibility and failing to adequately serve the client. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a clear understanding of client needs and regulatory requirements. This involves 1. Client assessment, continuously evaluating the client's risk profile, financial goals, and investment horizon. 2. Product suitability, matching client needs with appropriate financial products, considering all associated risks and benefits. 3. Regulatory compliance, adhering strictly to all applicable banking laws, RBI guidelines, and ethical codes of conduct. 4. Transparency and disclosure, clearly communicating all relevant information to the client, including risks, costs, and potential returns. 5. Client best interest, always prioritizing the client's financial well-being over personal or institutional gain. If a conflict arises, the client's best interest and regulatory compliance must take precedence. Question 14. Governance review demonstrates that a junior employee in the State Bank of India has inadvertently gained access to sensitive, non-public information regarding a significant upcoming market shift that will negatively impact a particular sector. This employee has a close personal friend who is heavily invested in that sector. The employee is considering how to handle this information, knowing that disclosing it would violate strict confidentiality agreements and bank policy. Option A. Attempt to subtly influence the friend's investment decisions through general market advice without mentioning the specific information or sector. Option B. Discreetly inform the friend about the impending market shift, advising them to divest their holdings without revealing the source of the information. Option C. Delete the information and pretend they never saw it, hoping the situation resolves itself without any intervention. Option D. Immediately report the information and the potential conflict of interest to their direct supervisor and the compliance department, requesting guidance on how to proceed. The correct answer is D. Immediately report the information and the potential conflict of interest to their direct supervisor and the compliance department, requesting guidance on how to proceed. Explanation. Scenario analysis. This scenario presents a classic ethical dilemma where a junior employee is privy to information that could significantly benefit a close personal acquaintance, but doing so would violate confidentiality policies and potentially harm the bank's reputation and client trust. The challenge lies in balancing personal loyalty with professional integrity and adherence to regulatory expectations. The pressure to act, coupled with the potential for personal gain, even if indirect, makes this a test of ethical fortitude. Correct approach analysis. The correct approach involves immediately reporting the situation to the designated authority within the bank, such as the compliance department or a direct supervisor. This aligns with the State Bank of India's (SBI) Code of Conduct and Ethical Guidelines, which emphasize integrity, confidentiality, and the duty to report potential breaches. By escalating the matter, the employee upholds their fiduciary duty to the bank, protects client information, and allows the bank to manage the situation according to established protocols, thereby preventing potential regulatory violations and reputational damage. This proactive reporting demonstrates a commitment to ethical conduct and responsible behavior, which are paramount in the banking sector. Incorrect approach is analysis. Sharing the information with the acquaintance, even with the intention of helping them, constitutes a direct breach of confidentiality. This violates the SBI's internal policies and potentially the Banking Regulation Act, 1949, which mandates the secrecy of customer information. Such an action could lead to severe disciplinary action, including termination, and could also expose the bank to legal liabilities and regulatory penalties. It erodes client trust, a cornerstone of banking operations. Attempting to subtly influence the acquaintance to avoid the specific investment without revealing the confidential information is still problematic. It might seem like a less direct breach, it still involves using privileged information for personal influence, which is unethical. It also carries the risk of the acquaintance inferring the source of the information, leading to a potential disclosure of confidential data indirectly. Furthermore, it bypasses the bank's established risk management and advisory processes. Ignoring the information and hoping it resolves itself is also an unacceptable approach. This inaction can be construed as negligence and a failure to uphold professional responsibilities. If the situation escalates and causes harm, the employee could be held accountable for not reporting a known risk. This passive stance undermines the bank's internal control mechanisms and its commitment to proactive risk management, which are critical for maintaining regulatory compliance and market confidence. Professional reasoning. Professionals in the banking sector must adopt a decision-making process rooted in ethical principles and regulatory compliance. When faced with a potential conflict of interest or a breach of confidentiality, the primary steps should be: 1. Identify the ethical and regulatory implications. 2. Consult internal policies and codes of conduct. 3. Report the situation promptly to the appropriate authority. 4. Avoid any action that could be construed as a breach of trust or confidentiality. This systematic approach ensures that decisions are made in the best interest of the bank, its clients, and the broader financial ecosystem, while safeguarding personal and professional integrity. Question 15. The monitoring system demonstrates a pattern of unusually large cash deposits into a customer's account, followed by immediate transfers to multiple overseas accounts. While the customer's stated business activities do not typically involve such high volumes of international transactions, the employee handling the account has a close personal relationship with the customer. The employee is aware of the customer's financial difficulties and has previously facilitated minor deviations from standard procedures for this customer. What is the most appropriate course of action for the employee? Option A. Directly inform the customer about the flagged transactions and inquire about the nature of their business to understand the reason for the large deposits and transfers. Option B. Discuss the observed transactions and the employee's suspicions with a trusted colleague in another department to seek their opinion on how to proceed. Option C. Discreetly escalate the observed pattern and concerns to the bank's compliance officer or Suspicious Activity Reporting Unit for investigation, adhering strictly to internal reporting protocols. Option D. Ignore the transactions, as the employee has a personal relationship with the customer and wishes to avoid causing them undue stress or suspicion. The correct answer is C. Discreetly escalate the observed pattern and concerns to the bank's compliance officer or Suspicious Activity Reporting Unit for investigation, adhering strictly to internal reporting protocols. Explanation: this scenario presents a professional challenge because it pits the imperative of customer confidentiality against the need to report potential financial irregularities. A bank employee, privy to sensitive customer information, discovers a pattern that could indicate illicit activity. The core dilemma lies in balancing the duty of secrecy owed to the customer with the broader responsibility to uphold the integrity of the financial system and comply with anti-money laundering (AML) regulations. This requires careful judgment to avoid both breaching confidentiality unnecessarily and failing to report suspicious activities, which could have severe legal and reputational consequences for the bank and the individual. Correct approach, which involves discreetly escalating the concern through internal channels to the designated compliance officer or Suspicious Activity Reporting (SAR) unit, represents best professional practice. This aligns with the State Bank of India's (SBI) internal policies and the broader regulatory framework governing financial institutions in India, particularly the Prevention of Money Laundering Act, 2002, PMLA, and its associated rules. These regulations mandate that financial institutions establish robust internal controls and reporting mechanisms for suspicious transactions. By following the prescribed internal reporting procedure, the employee acts responsibly, ensuring that the matter is investigated by trained professionals who can assess the situation objectively and, if necessary, file a SAR with the Financial Intelligence Unit India (FIUIND), without prematurely disclosing information to the customer or unauthorized parties. This upholds both customer privacy and regulatory compliance. An incorrect approach would be to directly confront the customer about the suspicious activity. This is a significant regulatory and ethical failure. It breaches the fundamental principle of customer confidentiality, which is protected under various banking laws and ethical codes. Furthermore, it could alert the customer to the investigation, allowing them to conceal or destroy evidence, thereby hindering any potential investigation and prosecution. This action also bypasses the bank's established AML reporting procedures, failing to comply with the PMLA and potentially exposing the bank to penalties for inadequate internal controls. Another incorrect approach would be to ignore the suspicious activity altogether. This constitutes a failure to comply with the employee's duty to report suspicious transactions as mandated by the PMLA and SBI's internal AML policies. By overlooking the red flags, the employee becomes complicit in potential money laundering or other financial crimes, exposing themselves and the bank to severe legal repercussions, including fines and reputational damage. It demonstrates a lack of diligence and a disregard for the integrity of the financial system. A third incorrect approach would be to discuss the suspicious activity with colleagues who are not involved in compliance or the investigation. This is an ethical breach of confidentiality and a violation of internal data protection policies. It risks spreading unverified information, potentially damaging the customer's reputation, and creating an environment of gossip and mistrust within the workplace. It also undermines the formal reporting channels and could compromise the integrity of any subsequent investigation. The professional decision-making process for similar situations should involve a clear understanding of the bank's internal policies and relevant regulations. When encountering potentially suspicious activity, an employee should first assess the situation based on their knowledge and the information available. If the activity appears to warrant further scrutiny, the next step is to consult the bank's AML/KYC, Know Your Customer policies and procedures. The employee should then escalate the concern through the designated internal reporting channels, such as the compliance department or a specific reporting officer, providing all relevant details in a factual and objective manner. This ensures that the matter is handled by the appropriate authorities within the bank, who are equipped to make informed decisions regarding further investigation and reporting to regulatory bodies. Confidentiality must be maintained throughout the process, and speculation or unauthorized disclosure of information must be strictly avoided. Question 16. Quality control measures reveal that a long-standing client who has previously expressed a conservative investment approach and a low-risk tolerance is now requesting to invest a significant portion of their portfolio into a high-risk, volatile equity fund. The client states they are eager for quick returns, a sentiment that contradicts their historical financial behavior and stated objectives. You are aware that this fund offers a substantial commission. How should you proceed? Option A. Immediately escalate the matter to your branch manager, informing them of the client's request and your concerns without conducting any further personal assessment. Option B. Conduct a thorough review of the client's current financial situation, risk tolerance, and investment objectives, and explain to the client why the proposed fund may not be suitable based on these factors and regulatory guidelines. Offering alternative suitable options. Option C. Politely decline the client's request without providing a detailed explanation, citing internal bank policy. Option D. Proceed with the investment as requested by the client, as they are a long-standing client and the commission is significant. The correct answer is B. Conduct a thorough review of the client's current financial situation, risk tolerance, and investment objectives, and explain to the client why the proposed fund may not be suitable based on these factors and regulatory guidelines, offering alternative suitable options. Explanation. Scenario analysis. This scenario presents a professional challenge due to the conflict between a client's perceived immediate need and the bank's ethical obligation to ensure suitability of financial products. The pressure to retain a long-standing client, coupled with the potential for a significant commission, can create an incentive to overlook potential misalignments. The core challenge lies in balancing client relationship management with fiduciary responsibilities and adherence to regulatory guidelines designed to protect investors. Correct approach analysis. The correct approach prioritizes the client's best interests and regulatory compliance. It involves a thorough reevaluation of the client's financial situation, risk tolerance, and investment objectives against the suitability of the proposed product. This aligns with the principles of Know Your Customer (KIC) and suitability regulations mandated by the Reserve Bank of India, RBI, and Securities and Exchange Board of India, SEBI, guidelines. These regulations emphasize that financial products recommended must be appropriate for the client's circumstances, and a bank employee has a duty to act in good faith and with due diligence. Documenting the rationale for any recommendation, especially when it deviates from initial assessments, is crucial for accountability and compliance. Incorrect approaches analysis. Recommending the product without further investigation, despite the red flags, constitutes a failure to adhere to suitability norms. This could lead to client detriment if the product is indeed unsuitable, violating the bank's duty of care and potentially breaching SEBI regulations on fair dealing and investor protection. It also ignores the internal quality control findings, undermining the bank's risk management framework. Escalating the issue to a superior without first conducting a preliminary review and forming an informed opinion demonstrates a lack of initiative and professional responsibility. While escalation is sometimes necessary, it should be based on a reasoned assessment, not an abdication of duty. This approach fails to leverage the employee's knowledge and understanding of the client and the product, potentially burdening management with details that could have been initially assessed. Directly refusing the client's request without a clear, documented explanation based on suitability concerns could damage the client relationship unnecessarily. While the client's request may be problematic, a professional approach involves explaining the rationale behind any refusal or modification of the recommendation, referencing regulatory requirements and the client's own stated objectives. This approach risks appearing unhelpful and dismissive, even if the underlying concern is valid. Professional reasoning. Professionals in banking must adopt a structured decision-making process that begins with understanding the regulatory landscape and ethical obligations. When faced with a conflict, the process should involve 1. Identifying the core issue and potential conflicts of interest. 2. Consulting relevant internal policies and external regulations, RBI, SEBI. 3. Gathering all necessary information, client profile, product details, quality control findings. 4. Analyzing the information against regulatory and ethical standards. 5. Formulating a recommendation or course of action that prioritizes client well-being and compliance. 6. Documenting the decision-making process and rationale. 7. Escalating appropriately if uncertainty or significant risk remains. Question 17. Strategic planning requires a clear understanding of market opportunities and potential risks. A branch manager at State Bank of India, tasked with increasing new customer acquisition for a specific loan product, discovers that a competitor bank has achieved significant success by offering a slightly more aggressive interest rate, which appears to be based on analyzing publicly available demographic data of a specific high-income locality. The manager considers replicating this strategy by analyzing similar demographic data of a target locality to identify potential customers, even though explicit consent for such granular data analysis for marketing purposes has not been obtained from the individuals. What is the most appropriate course of action? Option A. Replicate the competitor's strategy by analyzing demographic data of the target locality to identify potential customers, assuming that the competitor's actions are legal and ethical. Option B. Inform the sales team to proactively reach out to individuals in the target locality, highlighting the loan product's benefits, and then gather their demographic information during the application process. Option C. Proceed with the data analysis using publicly available demographic information, as this is a common market research practice and does not involve direct access to confidential customer data. Option D. Escalate the matter to the bank's compliance department to seek guidance on ethical and regulatory compliant methods for customer acquisition, exploring alternative strategies that do not compromise data privacy. The correct answer is D. Escalate the matter to the bank's compliance department to seek guidance on ethical and regulatory compliant methods for customer acquisition, exploring alternative strategies that do not compromise data privacy. Explanation. This scenario presents a professional challenge rooted in the conflict between achieving strategic business objectives and upholding ethical conduct, particularly concerning customer data privacy and fair lending practices, which are paramount under Indian banking regulations. The pressure to meet targets can create a temptation to engage in ethically questionable shortcuts. Careful judgment is required to balance profitability with regulatory compliance and customer trust. The correct approach, which involves escalating the issue to the compliance department and seeking guidance on alternative compliance strategies, represents best professional practice. This aligns with the Reserve Bank of India's (RBI) Guidelines on Fair Practices Code for Banks and its emphasis on data protection and customer grievance redressal. It demonstrates a commitment to ethical conduct, regulatory adherence, and responsible business operations. By involving the compliance department, the employee ensures that any proposed solutions are vetted against legal and ethical standards, protecting both the bank and its customers. An incorrect approach of proceeding with the data analysis without explicit consent or proper anonymization would violate the RBI's master directions on data protection and privacy, potentially leading to severe penalties and reputational damage. This disregards the principle of informed consent and the bank's duty to protect customer information. Another incorrect approach of fabricating data to meet targets would constitute fraud, a serious ethical and legal breach, undermining the integrity of the bank's operations and its financial reporting, which is strictly prohibited by banking laws and the Indian Penal Code. A third incorrect approach of ignoring the ethical concern and continuing with the original plan, despite knowing it might be problematic, demonstrates a lack of integrity and a failure to act in the best interest of the bank and its customers, violating the fundamental principles of professional conduct expected of SBI employees. Professionals should adopt a decision-making framework that prioritizes ethical considerations and regulatory compliance. This involves 1. Identifying the ethical and regulatory implications of a proposed action. 2. Consulting relevant internal policies and external regulations. 3. Seeking guidance from supervisors or specialized departments like compliance or legal when in doubt. 4. Exploring alternative ethical and compliance solutions. 5. Documenting all decisions and actions taken. Question 18. System analysis indicates that a bank employee, while performing their duties, inadvertently gains access to confidential, unpublished information about an upcoming merger that is highly likely to significantly increase the share price of one of the involved companies. The employee recognizes this information as price-sensitive and is aware that trading on it would be illegal. However, the employee also has personal financial difficulties. What is the most ethically and regulatorily sound course of action for the employee? Option A. Share the information with a close friend who is a savvy investor, suggesting they consider investing. Option B. Immediately report the information to the bank's compliance department or designated supervisor. Option C. Continue with regular duties, assuming the information will eventually become public without any personal involvement. Option D. Discreetly purchase shares of the company before the merger announcement to alleviate personal financial stress. Correct answer is B. Immediately report the information to the bank's compliance department or designated supervisor. Explanation. Scenario analysis. This scenario presents a conflict between a bank employee's personal financial interests and their professional duty to act in the best interest of the bank and its clients. The employee has access to non-public information that could significantly impact the market value of a particular company's shares. Exploiting this information for personal gain would constitute insider trading, a serious ethical and regulatory violation. The challenge lies in the employee's temptation to leverage their privileged position for financial benefit, which requires strong ethical resolve and adherence to established codes of conduct. Correct approach analysis. The correct approach involves immediately reporting the potential insider information to the designated compliance department or supervisor. This aligns with the State Bank of India's (SBI) internal policies and the broader regulatory framework governing financial institutions in India, such as the Securities and Exchange Board of India (SEBI) regulations. SEBI Prohibition of Insider Trading (PIT) Regulations, 2015, strictly prohibits individuals from trading securities while in possession of unpublished price-sensitive information, UPSI, and mandates reporting such information. By reporting, the employee upholds their fiduciary duty, prevents potential market manipulation, and ensures compliance with legal and ethical standards. This proactive disclosure demonstrates integrity and commitment to maintaining a fair and transparent market. Incorrect approaches analysis. Acting on the information to buy shares before the announcement would be a direct violation of SEBI PIT regulations, 2015. This constitutes insider trading, which carries severe penalties including fines and imprisonment. Ethically, it is a breach of trust and fairness. Sharing the information with a friend or family member, even without directly trading oneself, is also a violation of insider trading regulations. This is considered tipping and makes the employee liable for aiding and abetting insider trading. It undermines the principle of equal access to information for all market participants. Ignoring the information and continuing with normal duties without reporting it is also problematic. While not an active violation, it demonstrates a lack of diligence and a failure to uphold the responsibility to report potentially market-moving information. This could be seen as a passive complicity if the information later surfaces and causes market disruption, and it fails to adhere to the spirit of regulatory compliance. Professional reasoning. Professionals in the banking sector must cultivate a strong ethical compass. When faced with situations where personal gain might conflict with professional duties, the decision-making process should prioritize adherence to regulatory frameworks and internal codes of conduct. This involves 1. Identifying the potential conflict of interest and the nature of the information, e.g., is it unpublished price-sensitive information? 2. Recalling relevant internal policies and external regulations, e.g., SEBI PIT regulations. 3. Prioritizing the integrity of the market and the bank's reputation over personal financial benefit. 4. Taking immediate and appropriate action, which typically involves reporting to the compliance department or supervisor. 5. Documenting the action taken for accountability. Question 19. Compliance review shows that a branch is experiencing significant delays in customer onboarding due to a perceived inefficiency in the document verification stage. The branch manager proposes a rapid implementation of a new, informal checklist developed by a few senior staff members, believing this will expedite the process. However, the proposed checklist has not been formally reviewed for accuracy, completeness, or its impact on data security and regulatory adherence. Which of the following represents the most appropriate approach to address this perceived inefficiency while ensuring compliance with State Bank of India's operational guidelines and regulatory framework? Option A. Focus on reducing the number of documents required for onboarding, as this is the most direct way to speed up verification and address any compliance concerns retrospectively if they arise. Option B. Immediately adopt the new informal checklist proposed by the branch manager, as the urgency to improve customer experience outweighs the need for extensive formal review and monitor for any immediate issues. Option C. Delegate the task of creating a new verification process to the IT department, assuming they can automate the entire onboarding workflow without direct input from the operations team or a thorough understanding of the current manual steps. Option D. Conduct a detailed process mapping exercise of the current customer onboarding workflow. Gather data on the duration and error rates at each step. Identify specific bottlenecks, and then develop and pilot a revised process with formal risk assessment and stakeholder validation before full implementation. The correct answer is D. Conduct a detailed process mapping exercise of the current customer onboarding workflow. Gather data on the duration and error rates at each step. Identify specific bottlenecks, and then develop and pilot a revised process with formal risk assessment and stakeholder validation before full implementation. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of efficiency gains with the imperative to maintain robust internal controls and adhere to regulatory expectations for process documentation and risk management within the State Bank of India. The pressure to optimize can sometimes lead to shortcuts that compromise compliance. The correct approach represents best professional practice because it prioritizes a systematic, data-driven, and compliant method for process optimization. This involves thorough analysis, stakeholder engagement, and a clear understanding of the regulatory framework governing banking operations in India. Specifically, it aligns with the Reserve Bank of India's (RBI) guidelines on operational risk management and internal controls, which emphasize the need for documented processes, risk assessments, and continuous improvement initiatives that do not undermine compliance. By focusing on identifying bottlenecks through detailed process mapping and data analysis, and then implementing changes with proper validation and documentation, the bank ensures that optimization efforts are sustainable, transparent, and compliant with regulatory mandates. An incorrect approach that focuses solely on anecdotal evidence or rapid implementation without proper validation poses significant regulatory and ethical risks. Such an approach could lead to the introduction of new, undocumented risks or the exacerbation of existing ones, potentially violating RBI directives on risk management and internal audit. For instance, bypassing formal change management or risk assessment procedures could be seen as a failure to uphold the principles of sound banking practices and could attract regulatory scrutiny. Another incorrect approach, such as prioritizing cost reduction over process integrity, might lead to the elimination of critical control points, thereby increasing the bank's vulnerability to operational failures, fraud, or non-compliance with statutory requirements. This would be a direct contravention of the bank's fiduciary duty to its customers and stakeholders, and a breach of regulatory expectations for maintaining a secure and reliable banking environment. The professional reasoning process for similar situations should involve a structured approach. First, clearly define the objective of the optimization. Second, gather comprehensive data and map the existing process in detail. Third, identify potential risks and control points associated with the current process and any proposed changes. Fourth, consult relevant internal policies and external regulatory guidelines, e.g., RBI circulars on operational efficiency and risk management. Fifth, develop and evaluate potential optimization strategies, considering their impact on efficiency, risk, and compliance. Finally, implement changes through a controlled process with thorough testing, documentation, and post-implementation review. Question 20. Assessment of the most prudent approach for implementing a new digital customer onboarding process at the State Bank of India, aimed at reducing processing time and enhancing customer experience, while ensuring strict adherence to the Reserve Bank of India's guidelines on Know Your Customer (KIC) and data privacy. Option A. Conduct a pilot launch of the new digital process in a few select branches, accompanied by comprehensive staff training and a thorough review of feedback before a full-scale rollout. Option B. Immediately deploy the new digital process across all branches after a brief internal review, assuming staff will adapt quickly. Option C. Implement the new digital process incrementally across different departments over several months, with minimal initial training, relying on on-the-job learning. Option D. Focus solely on the technological aspects of the new process, assuming that operational and training needs will resolve themselves organically. The correct answer is B. Immediately deploy the new digital process across all branches after a brief internal review, assuming staff will adapt quickly. Explanation. Scenario analysis. This scenario presents a common challenge in banking operations, where a new process is introduced to improve efficiency. The professional challenge lies in balancing the immediate benefits of a new system with the potential risks of inadequate training and oversight, particularly in a regulated environment like the State Bank of India. Ensuring compliance with banking regulations, customer data protection, and operational integrity requires a meticulous approach to process implementation. The pressure to demonstrate quick results can sometimes lead to shortcuts, which can have significant regulatory and operational repercussions. Correct approach analysis. The correct approach involves a phased rollout with comprehensive training and pilot testing. This aligns with best practices for process optimization in the banking sector, emphasizing risk mitigation and compliance. The Reserve Bank of India, RBI, guidelines, while not explicitly detailing process optimization methodologies, mandate robust internal controls, risk management frameworks, and adequate staff training to ensure the security and integrity of banking operations. A pilot phase allows for identification and rectification of issues in a controlled environment, minimizing disruption and potential regulatory breaches. Thorough training ensures staff are competent in using the new system, reducing errors and enhancing compliance with data privacy norms and operational procedures. This proactive approach demonstrates a commitment to operational excellence and regulatory adherence. Incorrect approaches analysis. Implementing the new process without pilot testing or comprehensive training is a significant regulatory and ethical failure. This approach disregards the RBI's emphasis on sound internal controls and risk management. It increases the likelihood of operational errors, data breaches, and non-compliance with banking laws, potentially leading to penalties, reputational damage, and loss of customer trust. A phased rollout without adequate training or with insufficient pilot testing also presents risks. While a phased approach is generally sound, its effectiveness is severely undermined if staff are not adequately prepared or if initial issues are not thoroughly addressed during the early stages. This can lead to the propagation of errors and inefficiencies across the organization, contravening the spirit of regulatory expectations for continuous improvement and operational soundness. Professional reasoning. Professionals should adopt a structured approach to process optimization, prioritizing risk assessment and mitigation. This involves 1. Thoroughly understanding the existing process and identifying areas for improvement. 2. Designing the new process with clear objectives and measurable outcomes. 3. Conducting a comprehensive risk assessment considering regulatory compliance, operational impact, and customer experience. 4. Developing a detailed implementation plan that includes pilot testing, phased rollout, and robust training programs. 5. Establishing clear performance metrics and feedback mechanisms to monitor the effectiveness of the new process and make necessary adjustments. 6. Ensuring continuous review and adherence to all applicable banking regulations and ethical standards throughout the implementation and operational phases.